I think most of the move to a new reality in silver is going to occur in the next handful of months by summer. Okay. Now, there may be some after that, but the main goal is to get to the new reality. What do I mean by that? If you get a chart of copper, in fact, you can go to the Federal Reserve of St. Louis and type in copper, and they'll give you a chart going back to the 1980s or something. Look at that. You'll see that for decades, copper lived in a range from half a buck to $1.50 a pound. Decades of this up and down. That was its reality. Okay. And in 2005, late that year, copper broke out of that range on its own. It didn't have help from gold or silver or even other base metals. And it went up quadrupled in a matter of several quarters. Went up to 450. Okay. Boom. A new reality. And yeah, there were sharp sell-offs after that rally high, but the reality that then occurred over the next decades, the next 20 years, was basically either side of $4 as opposed to either side of $1. Okay. So copper moved to a new reality, and it did it quickly, which when it broke out of that price range, the $1.50 to 50 cents in late 2005, it didn't go to the new reality over 3 years. It went to the new reality in the next couple of quarters. Okay. And the exact same thing happened to lead back in 2007, where it had been in an old reality. Talking about lead, you can get that chart on the Federal Reserve too. And when it broke out in 2007, it went up like quadrupled in a couple of quarters and then lived in a new reality. How come silver was stuck in a half-century range, $4 to 50, $4 to 50, when those two base metals didn't? Gold didn't. Its mama market, made a high at $200, then it made a high at 850, then it made a high at 1920. So all those new highs in gold that were dramatically above the prior highs, silver was still capped at 50. What's going on? Well, that ended. Our momentum work told us that was going to end a year ago. We could tell, okay, we're coming up out of here now. We're going to blow through that nonsense, the idiot level, we called it. Because any idiot with the price chart could see $50 and thought that was it. You couldn't go through there. And when we did, we gushed. We got up, into the mid-90s, and they had some congestion and sell-offs, and then finally 122 was the top trade in January. And in 1.5 trading days, literally 1.5 trading days, the tail end of January, silver collapsed down big time to 70 and ultimately got down in the high 60s. And then all during February, after that January 31st, February 3rd price low, 1.5 days, silver congested above that level and built a base. We shot up out of that base based on our works a couple weeks ago, and price shot up into the mid 90s recently, upper 90s, I think, early this week, and up out of that basing action. Then with this headline story where you sucked in a lot of, hey, I want some too, they got bagged, and you pull back about into the middle of that price range, the basing period that occurred all during February. Our weekly momentum, though, pulled back to the top end of that basing action. So momentum showed a slightly different picture than price. Price went back down below the recent highs, which were in the low 90s of the basing period in February, got down into the, under 80 even. Now we're 83, 84. But momentum sat back on top of those highs when you plotted a momentum chart. So as far as we're concerned, okay, this pullback was to a kosher area. It's okay. If you see any stability here, like today we got some, you see some more tomorrow, assume that was it. Okay. Same assessment with gold, except it's a little firmer than silver of late. Generally, it's been weaker than gold over the last year. But there's some other things going on out there. Well, one of the things that told us also that we're going to have this move to a new reality was the spread relationship between silver and gold. In other words, when you divide an ounce of silver into an ounce of gold, express that as a percent. And back in 2024, 25, silver, I think early last year, silver got down to 1% of the price of an ounce of gold. Well, think about that. Okay. What does that mean? Well, if you go back and look at that 50-year range in price, where silver went up to 50 and 50, the two prior times that it went up to 50, here's where that spread was, 6.5% ounce of silver versus gold. And in 2011, it was 3.1%. We got down to 1. I mean, it's like silver's free relative to the mama metal. Well, our argument is not only is silver likely to go to a new price reality, but it's likely to retest or challenge or even take out the old relative performance reality it proved to have in 1980 at 6.5% of gold, and in 2011 at 3.1. Right now, we're about halfway there. 1.6 area percent of gold. Still dirt cheap on silver. But technically that spread is broken out. Now, when you can plot that spread chart month to month, you get a technical picture. And we got a basing action spanning like almost a decade. We broke through that in November. That started the clock. By the way, in November, silver was $56. So it had just broken out of the range, of the price range. And at that point, the silver spread just broke out of a basing action. And we find that whenever that spread breaks out, like it did in 79, just prior to the explosion to 1980, and it did in 2010, prior to the explosion in 2011, that spread told you something is engaged other than just the price chart. And sure enough, we went from $56 at November close to an intraday high of 122 in 2 months. 2 months, okay? And you get a pullback now, we're 84, okay? But you're still well above that $56 breakout level on the spread of November. Also, we find that when that spread breaks out, it tends to gush, not just the spread itself, the performance of silver, but the net price of silver tends to gush for a couple quarters. We're only in month 3 post the breakout, just starting month 3. We suspect this surge is likely to continue for handful of more months, 3, maybe 4, to keep the norm of what it does in the past. If you're just dumb and you say, well, what's the monetary degradation? You go look at an M2 chart, and you go back to 1980, how much money was in circulation, M2 monetary, measure. And in 2011, and compare that to where monetary growth is now compared to those time periods. How much is the money supply doubled, tripled, And if silver were to simply match the growth of the decay in the value of the money, or the increase in supply of the money, it'd be $300 to $500 just to match that. So that's another factor that you got to look at. It's a glacial factor. It's not a timing factor, but it's just a fact of reality that silver is vastly underappreciated, undervalued relative to what it's selling for.
The Iran war caused oil to surge, which caused inflation fears to surge, which caused bond investors to sell, which caused yields to rise, which caused stocks to fall further. A doom loop, a self-reinforcing spiral. Private credit funds gate, they stop rolling over loans. When the loans stop rolling over, companies can't refinance, and when the companies can't refinance, defaults rise. And when defaults rise, credit spreads widen, and when credit spreads widen, stocks fall further. Every piece of this puzzle connects to another piece. And here's what gold and silver investors need to understand. The Fed is now trapped. Oil prices are surging because of the Iran war, and that means that inflation is rising. But the labor market is collapsing. Rising inflation, falling employment. Now that's the textbook for, and it's the definition of stagflation. Stagflation is when prices are rising, but the economy is slowing. And that's what we're going into now. And historically, stagflation is one of the most powerful environments for precious metals that has ever existed. People move away from stocks and shares, and they move into precious metals. That's the obvious play, the safety of precious metals, because stocks are no longer going to be safe, defaults, lower profits, that sort of thing. Where do they go? Can't go into treasuries, that's higher inflation, forget that. So they go into precious metals, the perfect inflation hedge. So higher oil prices will mean higher energy costs for every business and every household. That means higher inflation. Higher inflation means the Fed cannot cut rates. And if the Fed cannot cut rates while the economy is shedding jobs, we have stagflation. Remember, when the real yield on bonds goes negative, that means that the inflation goes higher than the bond yield. So you have a negative real yield. When real yields go negative, gold and silver historically go parabolic. Now let's just pop back to JP Morgan, who back in October warned us about what was coming in the private credit market, which is now happening right now. What has JP Morgan got to say about the gold price? Well, they're saying they've just raised their gold price forecast to $6,300 by the end of this year, by the end of 2026, and they say that $8,000 is on the table. UBS has built a bull case for $7,200. ANZ has raised its Q2 26 forecast to $5,800. The reason they give is sustained safe haven demand and constrained supply. But I don't want you to focus on the price targets or the forecasts. I want you to focus on why gold should be rising. Gold is rising because the system that was supposed to protect investors, the private credit funds, the open-ended real estate vehicles, and there's plenty of them defaulting at the moment, is failing. Gold is rising because the dollar is being debased, because inflation's coming, they're going to have to print money to bail out the system. Gold is rising because the central banks around the world have been buying gold at record rates for the last 3 years, and they're likely to continue doing so. And they're going to continue doing so because it's the one money that you can trust when you can't trust the paper. And let's just talk about silver. Well, silver closed on Friday at $82 per ounce. And we know that as far as silver is concerned, we are in a deficit. That means that the mined production of silver is less than what has to be consumed by industry. The consumption of silver has been rising every year. The production of silver has been falling, so we're now at less silver being produced than a decade ago, and we're at the highest amount of silver being consumed ever. The only way that extra silver, that difference, that deficit can be met is by recycling of silver, people taking in their old coins or their silver candlesticks and melting them down. So the gold-silver ratio at the moment is historically elevated at around 60 times. That means that silver's relatively cheap to gold. Now, historically, when the silver ratio has been this elevated, silver has subsequently performed when prices next had their leg up. So if gold does go to $6,000, which is widely forecast this year and beyond, actually, then, and let's assume that the ratio of gold-silver resorts to its historical average, silver would be trading well over $100 compared with the $81 now. Now, what happens if gold goes to $8,000 and the gold-silver ratio goes to, let's say, 25, which would be a lot more normal than the current 60 we're at? I'll let you do the maths, but you can see where the silver price might well be going. Now, I said I'd update you on the COMEX numbers, and you'll see those on your screen in a second or two. The squeeze we expected in March kind of went away as the number of open interest went down very, very rapidly. Both shorts and longs closed their positions, and there was substantial rolling over of their positions into the May open interest here. So we've still got some open interest left in March, representing 6.5 million ounces. But in terms of registered silver, that's the silver which can be delivered. There's 81 million ounces in the CME warehouses. But coming up in May, there's open contracts for 384 million ounces. Now, that's not a different situation from what we saw back in March, where we had a huge number of a very large amount of open interest, which disappeared very rapidly as we approached the first delivery date. But the fact is, if we look at the amount of silver in the CME warehouses, it has been falling for months and months and months. And you can see it just here in less than a month, from the 18th of February through to the 5th of March. We're down another 7 million ounces, and eligible silver also was 279 down to 267. So silver is not only leaving the registered category, it's being taken out of CME warehouses and going somewhere, probably for production. It's also being taken out of the eligible category. That is to say, people who own the silver weren't necessarily intending to trade it on COMEX, so they're not turning